kind of losing money in mutual funds? Well, you don't have to be afraid of mutual funds if you understand them. Mutual funds offer you several options to achieve multiple financial goals. Hello and welcome. I'm Maheshi from Clear, India's largest tax and financial services platform. At Clear, we have assisted more than 6 million tax filers so far. If you have not already, do subscribe to our channel to support us. Let's get started. But first, why are mutual funds subject to market risk? You invest in financial instruments intending to earn the highest possible return. If you want higher returns from an investment, then you must be prepared to bear the additional risk that comes with the investment. You must have come across this marketing communication when investing in mutual funds. Mutual fund investments are subject to market risk. Please read the offer documents carefully before investing. So what does this mean? It means that your investment in mutual funds is vulnerable to market risk, which is the possibility of a decline in the stock market or the economy. It results in your mutual funds losing value irrespective of the performance of the issuing organization. For example, nearly every Indian stock lost value during the stock market crash of 2008 irrespective of the company's performance. While market risk is commonly associated with equity mutual funds that invest predominantly in stocks, different market risks impact debt and hybrid mutual funds. This table shows the types of market risk. Equity risk impacts equity funds which invest your money in stocks. The investment can lose value during a stock market crash even if the companies you invest in do well. Interest rate risk and credit risk impact debt mutual funds. Interest rate risk is the chance of investment losses occurring from a change in interest rates in the economy. However, interest rate risk mainly impacts debt funds which have bonds of longer duration in their portfolio. It is because uncertainty increases with time and it's difficult to predict how interest rates in the economy will move over a longer period. Certain debt funds invest in bonds which have a lower credit rating as these bonds offer higher interest rates to compensate for the extra risk you take. However, there is a chance that these bonds may default on their principal and interest payments called credit risk, and you may suffer losses if debt funds holds these bonds. Inflation risk is rising inflation makes goods and services costlier with time, eroding the value of the rupee and impacting your fixed income investment like debt funds. Socio-political risk refers to the possibility that events such as war or political instability may have a negative impact on the stock market in general. You may believe that fixed income investments such as bank fixed deposits are highly safe investments as you get back the money you invested along with the interest promised by the bank. You cannot be more wrong as you have forgotten inflation, which is the rise in prices of goods and services over time. You must look at the real rate of return from bank FDs which you get after accounting for inflation and taxes. The formula of real rate of return is 1 plus nominal rate divided by 1 plus inflation rate minus 1. Let's understand the real rate of return with an example. Suppose you invest in a bank FD which offers an interest rate of 7% per annum. The current inflation level is 5%. What would be the real rate of return from the bank FD? So, let's apply the real rate of return formula, that is, real rate of return is equal to 1 plus nominal rate divided by 1 plus inflation rate minus 1. Real rate of return from bank FD is equal to 1 plus 0.07 divided by 1 plus 0.05 minus 1 is equal to 1.9%. You are getting only around a 2% rate of return from the bank FD after accounting for inflation. Moreover, the interest you earn from bank FDs is taxed according to your income tax bracket, which further reduces your returns. So, how can you achieve major financial goals such as buying a house or retirement planning if you invest only in bank FDs? Wondering if you need risky equity investments to achieve your vital financial goals? Warren Buffett, the great American investor, once said, "Risk comes from not knowing what you're doing." If you're willing to bear a higher risk for a higher return, then you may invest in equity mutual funds. It has the potential to offer inflation-beating returns over time, thereby helping you attain long-term financial goals faster. However, there is a method of investing in equity called the Systematic Investment Plan or SIP, which is investing fixed amounts regularly in mutual fund schemes of your choice. SIP helps you average the purchase price of equity fund units over time, called rupee cost averaging. Moreover, you don't have to time the stock market if you invest in equity funds through the SIP. You don't require huge amounts, as you can invest just Rs 500 per SIP installment. You can enjoy the power of compounding benefit if you stay invested in equity funds for the long term. Let's understand how investing in equity funds through SIP magnifies the power of compounding. Suppose you invest just Rs 15,000 per month in equity funds through SIP for 25 years at an expected return of 10%. Your total wealth comes to Rs 2 crore at the end of the investment term. Use the ClearTax SIP calculator to arrive at the requisite figures. You can gain massive wealth over time using the power of compounding benefit. It helps you earn a return on the principal amount you invest in the equity fund and the returns you make over time. The power of compounding works on the reinvestment of your earnings from equity funds and time spent in the stock market. The power of compounding works best with equity investments as they have the potential to offer inflation-beating returns over time. I hope by now you have understood the risks of investing in mutual funds. If yes, write clear in the comments below or drop your questions if any. Now let's look at how to minimize risk with equity funds. You may choose equity funds which focus on diversification to reduce the risk of investing in equity investments. For instance, you could try investing in diversified equity funds which spread your investment across stocks of different industries and sectors. If one sector underperforms at any time, the other sectors may outperform and make up for this underperformance. Financial experts recommend that you take the diversification approach further by investing in global stocks. For example, the US stock markets may do well when the Indian stock markets are down, thereby protecting your investment. Moreover, it may be wise to allocate a portion of your portfolio towards fixed income investments such as debt funds, bank FDs, etc., which are not impacted by stock market movements. It helps preserve your wealth if the stock markets were to crash suddenly. So, what happens if you totally avoid equity investments and stick only with debt funds and other fixed income investments? Well, your fixed income investments are vulnerable to inflation risk or the rising prices of goods and services with time. Suppose you buy a leather jacket for Rs 5,000 today. Assuming an annual inflation of 6%, here's how much you must pay for the same leather jacket after 5, 10 and 20 years. This table shows how much money you will need to buy a leather jacket that you can buy with Rs 5,000 today. As you can see, the same leather jacket you can buy for Rs 5,000 today, you will have to pay Rs 16,551 after 20 years. As equity investments may offer inflation-beating returns over time, they could remain as your best bet against inflation. Invest in mutual funds to attain long-term financial goals depending on your risk tolerance. Understand the risks involved in mutual funds before investing in them. Thank you for watching this video. If you have any queries related to investment and taxes, please comment below. We will address them as soon as possible. Stay tuned for more videos and don't forget to subscribe to our channel for finance related content. Take care and goodbye.